if you didn't have such a long and fruitful relationship with Coke, Pepsi's right in your wheelhouse. I think the way the company's run, the products that it has, are you precluded in some kind of antitrust from owning both? Or?
No, I don't think the government would come after me. Pepsi, it's a wonderful company, and particularly, I mean, Frito-Lay is a fabulous business. I'd love to own it. I eat Fritos, I eat Cheetos, I eat their potato chips. I even eat Munchos, which are kind of hard to find, but I always drink Coca-Cola with them.
You know, Warren, I read your book, the biography on you, and it said that you started life drinking Pepsi, and those were the most joyful moments in your life. I love that. I think that's what keeps you so youthful, because Pepsi is about youthful cultures.
Well, I have to say, Indra, that I started drinking Pepsi when I was about 6 or 7 years of age in the 30s, and if you remember at that time, it was twice as much for a nickel, too. Pepsi gave you 12 ounces for a nickel, and Coke gave you 6.5 ounces. So I would definitely say that at half the price, Pepsi was a good buy at that time, marked down 50%.
Warren, let me assure you, at any price, Pepsi is a great product. Just as you talked about eating Cheetos and Fritos and Lay's potato chips, I hope I can get you on TV one day to say you drank one of our Pepsi products and loved it.
Well, I will probably I will eat some Cheetos and Fritos today, but I will also drink 5 Cokes.
Well, one thing's for sure, Beck.
You just touched on a point.
Beck, me, and Joe, we have got to get into that testing lab at Pepsi, right?
Oh, yeah.
We would have
That's
a blast.
right. I can see us
just
all
go
there.
crazy.
That would be fun.
I was just actually fantasizing about a way to make a Nutri-Salt, something that didn't hurt you but would have a salt taste, like a sweetener, like a fake sweetener, because... but I'm not even convinced.
That sounds like Olestra.
Yeah.
And you know what Olestra does to you, Joe.
Oh, that's right. That's right.
Joe,
that's right.
If you came to our laboratories, you'd be like a kid in a candy store.
It's true.
I assure you.
It's true.
We've got a real candy. Joe, we've got a real candy store for you at See's Candy. So
I love you too.
Don't settle for anything except See's Candy.
I love you two fighting over me. I can come to. I have time. I can come to See's and to Frito-Land. There should be a theme park for me.
We'll fly you back. We'll fly you back and forth in a NetJet too, Joe.
And at the end, there's a doctor waiting for you.
And let me just say one thing to Warren. Warren, Cheetos, Fritos, and Doritos taste fantastic and even better with Pepsi.
Boy, this is kind of a smackdown.
Yeah.
It is a smackdown.
It's a hard sell.
Warren, it is too bad that Coke never, you do have to go out of the Coke family to get a snack, and I wonder why they didn't realize salty snacks, drinks, salty. I mean, that's like peanut butter and jelly. That seems like a slam dunk to have thought of that.
Indra may know this better than I. My understanding is that Herman Lay went to Coke, I don't know, 40 years ago or so, and if a deal had been made, he would have owned more stock than Mr. Woodruff, and Mr. Woodruff didn't like it. But I don't know whether that's an old wives' tale or not. Indra, do you know the answer on that?
I think the answer is that PepsiCo has always been strategically much better than anybody else out there.
Oh, I like it. All right, we got to go.
Ouch.
I liked doing business early on. I used to buy Coca-Cola from them in 6-packs for $0.25 and sell them for $0.05 each. I had all kinds of little ventures, not all hugely successful, I might add.
In 1988, you started buying Coca-Cola. How come?
I don't remember exactly. Probably read their annual report. Probably read the 1987 annual report, and I've watched it some, but there just comes a point, there's a tipping point, in terms of knowledge you've accumulated over a period of time, price changes in the stock, which had gone down some. They were heavy repurchases of their own stock. Roberto and Don were doing a terrific job. Nothing bad was going to happen to Coca-Cola, so I started buying. Most of it in that period from the middle of 88 to early 89, but then a little further on. But we put overall about $1 billion into it, and it's probably worth about $8 billion now.
And you have no intent to sell?
No.
You have said, though, that during the bubble,
it got overpriced.
There were some things that you might have sold,
sure,
and would have been wise to have sold them at that time.
If I was running the partnership like I did back in the 60s, I definitely should have sold those stocks. I mean, stocks went crazy.
But you do not today look back and say, I should have sold Coca-Cola when the bubble was there, because...
It wasn't me. I mean, I wouldn't, I knew it was selling at a very fancy price, and I even wrote about it, and same way with Gillette. But But, you know, I don't do that very often. I'm not saying I wouldn't ever do it. I mean, if we went into the wildest speculative orgy in history, and some of these things went crazy, maybe I would sell some. But it's not it goes against the grain. For one thing, wonderful businesses are not that common. And if you get a big position in a wonderful business, not a bad thing.
What is the single best investment on a large scale that you have made?
Geico twice in my life, 3 times in my life has been a good investment. I mean, it was a good investment when I was really 20 years of age, and when I bought, I put 3/4 of my net worth in Geico when my net worth was like $10,000, and that caused my net worth probably to double or something like that, and that was great at the time. In 1976, the company got in trouble, and we bought what turned out to be half of the company for like $40 million. And then in 1995 or so, we bought the other half for $2 billion, and that was a good deal. So it's been a triple play.
Help me understand this. You're sitting with more than $40 billion, essentially in cash.
Right.
You could buy some big businesses, I would assume, for $40 billion.
Right.
But you don't see any at a price that you want to own.
That's right. And when I look at the deals that have been made in the last year, there's not one I'm envious of. So, I mean, it isn't like we missed them. I mean, it may turn out that I should have bought one of them, but I mean, there's none that I feel, gee, I wish I'd bought that last year. But I hope I buy one tomorrow.
I know, but I mean, there's nothing. I mean, you don't look at General Motors and say.
I look at General Motors. General Motors is selling for about $15 billion now. There's 500 million shares, 28 or 29, something like that. And the whole General Motors company, $15 billion. And of course, that was the most powerful company in the world, back when I was a kid. So
and you could have it in a second.
Well, I don't know about that, but I certainly could buy. I can buy plenty of.
What don't you know about that? I don't
well, I mean, buying the whole company is a different story.
How much is the whole company?
The whole company would cost $15 billion, about 100% of the stock. Yeah.
So why couldn't you pay $15 billion and get General Motors?
Well, they might not like me doing it and some other things.
Sure.
But,
I understand.
But nevertheless, I could buy a lot of stock at a valuation of $15 billion.
And you think it's a good buy today?
I think it's too tough to figure.
Too tough to figure?
Yeah. It is a company that sells 25% of all the vehicles in the United States and 1/7 of all the vehicles in the world, and employs hundreds of thousands of people, but it's got some terrible obligations outstanding.
Like Fiat, or that's what they've taken care of?
Probably, yeah. But the Fiat deal they solved for $2 billion.
Right.
But still $2 billion
Things
out the
like
door.
that, yeah.
But the big problem was that they really entered into contracts with the UAW that were based on the economics of market dominance, and they don't have market dominance anymore, but they still got the contracts. And I don't blame the UAW. I mean, it was a free will negotiation, but they signed up. I think they're paying like 2.5 people that don't work for every person that works, or something like that. In terms of retirement and health care, and that gets to be crushing if you're competing with people that don't have the same obligations.
You've looked at this closely.
Well, I look at all the things.
When you read 8 hours a day,
right.
You have a chance to cover a lot of.
But General Motors, and listen, I think they're doing a great job considering the hand they're dealt. But General Motors is a huge annuity and health insurance company with a major auto company attached. And unfortunately, the huge annuity and health company has got a terrible bunch of contracts out. I mean, it is worth some big minus number. And the question is whether the auto company is worth a big enough plus number to offset that big minus number, but you can't separate the two.
And you can't figure it out?
Well, I can figure it out.
No, but you can't what?
Well, in the end, I can't come to a conclusion that it's obvious that.
Well, that's what I mean. You can't come to a conclusion.
Right.
Because you don't have all the facts, or because...
No, I got the facts.
What don't you know? Why can't you reach a conclusion?
I don't know whether you can exist with the kind of obligations they've got in 25% of the market, and very tough people like Toyota and all kinds of people coming at them who don't have those costs. They call them legacy costs.
Here is the dilemma. You got $40 million in cash.
40 billion.
40 billion, I'm sorry.
There's a difference.
There's a difference, yeah. And you've gotten so big that you got to make a big play.
Right.
That's your problem.
That's my problem. And I thought it was a problem when we were a lot smaller, and it was, but it's a bigger problem now.
So what happened?
And if I'm lucky, it'll be an even bigger problem 5 years from now.
Tell me how the dilemma plays itself out for you.
The odds are good, Charlie, that one way or another we will find reasonably intelligent things to do with most of the money, but they won't be as intelligent as the things that we could find 30 or 40 years ago with much smaller amounts of money. Nowhere close.
Because there are few there.
They're right. It just can't. It won't happen.
What's the test? What test does it have to meet?
It has to be a business I understand. It has to be a company that I think has some kind of enduring competitive advantage. It has to be a management that I like and trust, and it has to be at a reasonably attractive price. Price is the least important, but it's still important.
And you'd like to own all of it?
I'd like to own all
But
of
not
it,
necessarily?
but not necessarily.
It's a very small... It's a small field to...
It's a small field when you get to have as much money as we have. It was a big field 30 or 40 years ago. When I bought the Washington Post stock in 1973 and 74, there were hundreds of companies that met my test. It was just a question of,
choosing the best.
Deciding, absolutely.
And the one you like the most?
Yeah.
The combination?
Mm-hmm.
You don't have any single candidate right now.
That's true. That's why you see these tears in my eyes.
It is. I mean, tell me the emotional feeling. I mean, you...
No,
I don't mean tears, but there is a certain sense of...
It's happened before. I mean, I closed up my partnership in '69 because I didn't feel there were any opportunities then in what I was doing, managing money, and there weren't. I mean, at least for me. And in the year in 1999 and 2000, in the general stock market, there was certainly nothing attractive, and we found some businesses then. But it happens from time to time. I mean, I am not in a business where you can do something smart every day. I'm not even in a business where you can do something smart every year. But I may be in a business where you can do something smart every 3 or 4 years.
Yeah, but I mean, I read every day about one more big deal by a group of private equity guys in the paper today.
Right.
SBC.
And they're using other people's money, and they get an override, and their calculus is not the same as my calculus. And right now, that enables them to pay way more.
Tell me how their calculus is different.
Well, it's money they get from somebody else that they get paid quite a bit of money on if they don't do anything, and then they get a percentage of the upside, and they don't take the downside. I mean, that is a different calculus than Berkshire's.
Yeah, you have the upside and the downside.
Upside and the downside, and I'm going to keep them forever, and I'm not going to dress up the accounting or rearrange things a little and resell it to the public.
You're not going to take a big fee for doing it.
No, so I don't have an exit strategy, and I'm not getting paid just to sit with a whole bunch of other people's money. It's my money.
When I look at something like a Coca-Cola, which has been around since 1886, I say to myself, they are now selling 1.6 billion 8-ounce servings of Coca-Cola products every day throughout the world. Everybody in this room has something in their mind about Coca-Cola, and I hope it's good, incidentally. And certainly, what are the chances that Coca-Cola will be selling more products 5 years from now or 10 years from now than presently? I would say it's almost a certainty. I mean, there will be more people. They will have more purchasing power. This product is a huge bargain. This product sells, if you buy it on weekend specials like I do, this product sells at about twice the price that it sold at 100 years ago. There aren't many products like that. So it represents, the cost of this represents for the average person maybe a minute or two of their earning power, and it provides a moment of refreshment and happy memories, all kinds of things. So will they be selling more Coca-Cola a few years from now than they are now? Almost certainly. They're Coca-Cola products. Able to price their product so as to counteract the effects of inflation and so on. Sure. So it's a pretty simple type of evaluation. I can't look at some new idea. People send me these big envelopes, filled with 200 pages of diagrams about some new product or process. I don't have the faintest idea what's going on in those things. But I can understand this. I can understand chewing gum. I mean, I've got a pretty big mind here. I got my mind around chewing gum years ago. And I stick with products
where I think I can really see what's likely to happen over 5 or 10 or 20 years. And then those variables that we talk about in terms of return on equity enter into my calculations. But the important thing is to be in the right business and with the right people. And if you're in the right business, you don't go crazy in terms of what you pay for it. It's just like my buying that farm. I didn't go crazy in terms of what I paid for the farm. I had an honest guy running it, happened to be my son. And, you know, now corn is selling, you know, for probably, well over twice the price it was in the mid-'80s. Soybeans are selling at 3 times the price. So the farm is worth more money than before. And over the years, it's just kept delivering a check to me every year. That's what investment is about. And it's really looking at the future income potential of a business and comparing it to what you have to lay out now to get that income potential. And that's investment. And I think that when you get into buying something where you're just betting on whether people will pay a little more for it next year, when it doesn't produce anything, there's nothing illegal about it. It's not illegal, it's not immoral, and it probably isn't financially fattening either. But you're betting on really investor attitudes or speculators' attitudes rather than betting on the asset itself.
So what attracts you to that can of Coke? Is it the taste or the fact that you've bought a major share into the company?
I didn't quite get
What attracts you to Coke? Is it the taste or the fact that you bought a major share?
Yeah, well, no, I don't want you to think of me as someone who would be up here drinking Coca-Cola because I had a financial interest in it. I mean, who would do that? Be sure you get this. We get the profits. We own about almost 9% of the company, so we get the profits on 1 out of every 11 cans. So if you have any of this out there, just open the can. I don't care whether you drink it or pour it on your neighbor. But just be sure you open the can. No, I'll make a confession here. You'd nail me on it anyway if I misled you. I drank Pepsi for a long time. And the reason I drank Pepsi was that when I was a kid, Pepsi came in a 12-ounce bottle for a nickel, and Coke came in a 6.5-ounce bottle for a nickel. And you probably have gained enough insight into my personality by this point that you would understand why I chose Pepsi. And then Pepsi for a long time, it's a very interesting story because it's very hard to change the personality of a product in the consumer field. I mean, it's very dangerous to be, selling a product with one promise made through advertising and so on, and then shift gears. Pepsi did that successfully. Pepsi always was twice as much for a nickel too was their slogan. In the 1930s, the #1 jingle was Pepsi-Cola hits the spot, 12 full ounces, that's a lot, twice as much for a nickel too. Pepsi-Cola is the drink for you. Well, it was delivered somewhat more professionally than that. But it was sold on the basis that you were getting twice as much for a nickel. And then and that worked for a long time. It gave Pepsi a position, but it positioned it as a price product. And then they made the shift successfully, which was remarkable. Sometime after World War II, they decided instead of selling the cheaper product, they would do Pepsi for those who think young and all these different other ideas. And they successfully replaced, in the public's mind, a product that was offered based on price with one that was offered based on some other quality. And it was a remarkable marketing achievement, one of the great ones of all time. So when they went to where they were charging the same price as Coke, I had to go for the real thing at that point.
You mentioned earlier about Coca-Cola becoming a little bit less efficient than they used to be.
For the first 100 years, all that caffeinated, carbonated sugar water with the same flavor just swept the earth. Every year more money came in. They were drowning in money for the better part of 100 years. Of course it was interesting, but of course that kind of spoils you. And now the basic stuff is going the other way.
Do you think Coca-Cola and Pepsi still win the sparkling water battle?
I don't know. I think they're both very strong companies, and I think they both have a lot of momentum in place. And
do you think if they were run by 3G, they would do better or worse?
Well, I guarantee they'd do a lot better the second year. Gone. When we bought that Coca-Cola, it was 1 million shares. It took us 8 months to buy 1 million shares of Coke. We were buying like half the trading every day. It's hard to get into all of these big blocks.
Coca-Cola is a fabulous company. Coca-Cola will sell over 21 billion cases of various products, more Coke than anything else, around the world this year, and it goes up every year. It's interesting, the stock in 1997 or 98, whenever it was, sold over $80 a share when the earnings were, I don't remember whether they were $1.50 a share or something like that. And the earnings then were not as of good quality as the earnings are now when, they were $2.17 or something like that. So it strikes us as a really wonderful business that sold at a very silly price some years back, and you can definitely fault me for not selling the stock. I always thought it was a wonderful business, but clearly at 50 times earnings, it was a silly price on the stock.
Coca-Cola is one example. The value of your holdings gone down by about $8 billion, haven't they?
That's you hit it right on the button. Let's keep this quiet, though.
I mean, do you ever say, man, what am I doing here? My commitment to the end is...
No. Looking back, I made a mistake by not selling Coca-Cola.
You could have sold it at the time, 3 or 4 years ago,
or
right?
something. Yeah, but no, I don't look back on things.
Okay, but let me just stay with that idea.
Yeah.
So you look back and you say, when it was $80 a share, I should have sold it because that was at its top, say, or close to its top, and
50 plus times earnings.
Right.
Yeah.
50 times earnings. But it's not in your blood to want to sell.
No, but I do sell marketable securities sometimes.
Okay,
I don't sell businesses.
Right.
But I do sell marketable
sure, and this
securities.
is a marketable security.
That was a marketable security.
As is American Express,
Yeah.
as is...
Yeah, but I don't sell See's Candy or the Buffalo News.
Oh, sure.
Yeah, I don't sell businesses.
So you're married to them for better or worse?
Yeah, I've got one section in the annual report, and I put it in every year, that if a business like that promises to lose money indefinitely, or if they have major labor problems or something, but just because I don't think it's going to do very well, or I could use the money better elsewhere, or because I get offered a crazy high price for something, I don't sell them. I got offered a crazy high price for something here recently that we own, and I told the fellow that called me, I said, I don't do it. You can look in the back of the annual report and you'll see I don't do it. He said, well, I read it, but I didn't believe it. He said, I believe it now.
He thought he could buy it, and he
thought
found out he could.
He named a number to me
And it was a good number.
It was a good number.
And I would like to know what your prediction is for Coca-Cola's long-term growth versus Pepsi-Cola's recent efforts to increase their competitiveness with Coke.
Yeah. Long term, I would expect Coke to continue to gain versus Pepsi.
What has he been doing while I was gone? What'd you say, Charlie? I knew I was taking a chance. What was the question?
I said that long term, I expected Coke to continue to gain versus Pepsi.
Oh, well, it's those kind of insights is why we keep him on the job year after year. In a moment of particular confidence, he one time told me the same thing about RC.
Simple fact is that all of the time and money and skill poured into consumer research on the new Coca-Cola could not measure or reveal the depth and abiding emotional attachment to original Coca-Cola felt by so many people. They said that they wanted the original taste of Coca-Cola back, and they wanted it soon. We brought you the new taste of Coke. We knew that millions would prefer it, and millions do. And we knew that it would beat the taste of our major competitor, and it does. What we didn't know was how many thousands of you would phone and write asking us to bring back the classic taste of original Coca-Cola. Well, we read and we listened, and you know the rest. They're both yours, the new taste of Coke and Coca-Cola Classic. Your right of choice is back.
Warren, did he talk to you about that decision at the time? I mean, you were on the board, by the way.
No, I wasn't on the board at that time.
Okay.
In fact, none of us were there at that time. You have to understand.
You don't know anybody that was there.
No, I was out of communication. But the one thing he did tell me, he said, he was talking to me about it afterwards, and he said, when those letters started arriving at headquarters addressed to Supreme Idiot, and they brought them into my desk, he said, I started to get the idea maybe we'd lost a little something here.
Coke asked shareholders to approve a magnanimous stock option program for its executives. Asked about it by the press after the vote, you said the program was excessive. Yet you did not tell the world prior to the Coke shareholders meeting that you believed the program to be excessive, a disclosure that, had it been made earlier, might have made shareholders vote against it. And in fact, you did not vote Berkshire's shares against the plan. You only abstained in the voting. But I still would like to know why you engaged in this very strange, un-Buffett-like behavior.
Well, some people incidentally think that strange and un-Buffett-like are really not quite right. It's strange is frequently Buffett-like. I did talk to Muhtar Kent, and I informed him that we were going to abstain. I told him that we admired enormously the Coca-Cola Company, we admired the management, and we thought the compensation plan, although it was very similar to a great many plans, was excessive. And Muhtar and I had a very good discussions right here in Omaha, as a matter of fact, as well as a couple of telephone discussions. And then immediately after the vote, I announced that we had abstained and gave the reasons that we thought the plan was excessive. And I think that in terms of having an effect on the Coca-Cola compensation practices, as well as maybe having an effect on some other compensation practices, that is the most effective, was the most effective way of behaving for Berkshire. We made a very clear statement about the excessiveness of the plan, and at the same time, we in no way went to war with Coca-Cola. We have no desire to go to war with Coca-Cola.
Well, Coca-Cola continues to sell more drinks, a wider portfolio than they used to have many years ago, more every year than the year before. But the growth rate in carbonated soft drinks 20 years ago was a lot greater than today. It's still very strong. I mean, I think they sell like 1.9 billion 8-ounce servings of some drink every day, and a lot of that's Coca-Cola. So it's a very good business, but the growth rate has slowed down considerably from where it was, we'll say, 20 years ago.
We know that the company just recently announced that it's stepping up the restructuring of its North American operations. It's trying to push ahead the move to get out of Coca-Cola bottlers.
Yeah.
Is that the right move?
Well, it's hard to tell. I mean, they bought up the bottling operations, I don't know, 5 or 6 years ago, with the idea of refranchising them later on. So, I mean, this is part of a plan. They drifted in 1899 for $1. They made a deal with 3 guys from Chattanooga. It was the dumbest deal ever made. They gave in perpetuity the rights in almost the entire United States to these guys for the bottling operation, and that led to all kinds of things over time. Then those fellows made sub-arrangements and all of that sort of thing. Working their way out of that, it started 40 or 50 years ago, and my friend Don Keogh had a big part of the job. And they, as he said, he loved and threatened and cajoled and pleaded, all these things to try and get this thing into a more logical arrangement. And they've been working on that for a long time, and this is part of a very long-term plan to have the most logical distribution system that fits today's retailing. I mean, there weren't Walmarts and those around 100 years ago. So you had local accounts entirely then. Now you have big national accounts, and it's a different world. But it's been expensive, been very expensive to reconfigure the distribution arrangement.
What was the purchase of CCE, Coca-Cola Enterprises? Was that the right move back in 2010?
They probably felt it was the only move but they created CCE, of course, 20 years earlier. I mean, it's been a tough problem to align the interests of the bottlers and they call it concentrate manufacturing part of it. And it's different by different countries. It's not an easy puzzle, but they had decided that to have the United States in particular more logically configured, reinvigorated in terms of the bottling partners they might have and so on. They've got a terrific bottler, for example, that they've added in Chicago. I know the people. So the scorecard isn't in on it. They paid a lot of money, and they're not going to get back that much money, it doesn't look to me like, in terms of when they refranchise it. But that isn't really the key. The real key is how vigorous the system is once it's been put in place. And they've accelerated the timetable for getting it refranchised.
The company named a new president and chief operating officer, James Quincy, back in August. Do you know him?
I met him once, and I've got a dinner coming up with him here pretty soon. Everything I know about him is good.
Okay. There's a question from a viewer that comes in asking, this is from Shop Two Friends, will 3G buy Coca-Cola in the next few years?
I don't think so. No, Coca-Cola is not for sale. And I would say this, we own 9% of it, so we might have a little bit
to say in that?
Yeah.
Okay, let's turn our attention a little bit about American Express. This is another question from a viewer, Dave Carson, who writes in, how do you rationalize Berkshire's continued investment in American Express given its troubles?
Well, American Express,
I would say most of the big food companies are good businesses in that they earn good returns on tangible assets. And I don't want to get into particularly into specifics on Kraft, but if you own important branded products in this country, whether it's Wrigley's or Mars or Coca-Cola or a number of the Kraft brands or See's Candy, you have good assets. It's not easy to take on those products. Just imagine, taking on Coca-Cola will sell 1.5 billion 8-ounce servings of its product around the world today. There's something in every person's mind virtually in the globe about Coca-Cola. That's a product of, since 1886, has been associated with happiness and good value in terms of refreshment and all that. It's just about impossible, to, in my mind anyway, to take on a product like that. It clearly satisfies people in a way, everywhere on the globe. And, it may not be the same Kraft, for example, as Kool-Aid in the powdered soft drink business. I don't think I'd want to try and take on Kool-Aid. I'd rather have Coca-Cola, but it's a tough product. And to get implanted, to get implanted in people's mind RC Cola around the world. And RC Cola's been around a long, long time. It isn't going to go anyplace. I mean, that is very, very difficult. And actually, Richard Branson came over to this country. They say that a brand is a promise. I mean, there's a promise involved in picking up a Milky Way or picking up a Coca-Cola as to what it's going to deliver to you. Richard Branson came over 7 or 8 years ago, 10 years ago, a fellow with a famous airline and all of that. And he came out with something called Virgin Cola. Now, I thought that was kind of an unusual promise to have in a product. Never could quite figure that one out, what the promise was. But whatever it was, it didn't work. And there've been, I don't know how many, Don Keogh would know, but there have been hundreds of colas over the years. But in the end, who is going to buy some substitute cola for a penny a can less, or 2 cents a can less than Coca-Cola, or the same thing with See's Candy, or the same thing with Kool-Aid, or whatever it may be. So we feel pretty good about branded products when they're runaway leaders in their field. And there's nothing unusual about Kraft in their position versus Kellogg or some other people like that. So the specifics of which one we buy may depend a little bit on how we feel about the price. It certainly will make a difference how we feel about the price, the management, and some other factors. But if you buy in with good branded products and you don't pay too much, you're probably going to do okay. On the other hand, you're not going to get super rich because the attributes that I've just laid out are pretty well recognized.
The other issue that seemed to come up a lot was concerns about changing taste, consumer taste in the food industries that Berkshire owns major stakes in. Companies like Kraft, companies like Coca-Cola, people concerned about whether this food is good for them, and that's something that millennials in particular have been thinking about.
People have been drinking Coca-Cola since 1886, so I imagine that there's been some, I don't know of any study that's been made on the lifetime of heavy users of Coca-Cola versus people who drink nothing but water. But speaking for myself, I'm 84. Literally 1/4 of all the calories I've consumed in the last 30 years have been Coca-Cola. And I don't see how anybody can feel any better than I feel. I am 1/4 Coca-Cola, and I can tell you I've missed a day of work, since I had the prostate cancer radiation 3 years ago, and I don't think the prostate cancer was caused by Coca-Cola. So and all my friends drink it like crazy. So there's 1.9 billion 8-ounce servings of Coca-Cola products sold around the world today. And there will be more than 1.9 billion a year from now, and more than that 5 years from now, and more than that 10 years from now. And that's been true. And some people will like other things, and if they like broccoli and Brussels sprouts, God bless them, but don't invite me for dinner.
I think the question became not what your preferences are, but whether you recognize and think that companies like Coca-Cola, or whether it's Heinz or Kraft, are going to have to transform themselves over the next 10 years, meaning will people be drinking Coca-Cola, or will they be drinking it may be a Coca-Cola product, but a different type of product, and whether your tastes, by the way, are in line or out of line with the sort of transformation in tastes, at least in this country and abroad.
There's no question that additional tastes evolve. That doesn't mean that people's enthusiasm for the old taste disappear, but the diet product came about in the 1960s. In fact, I think it was R.C. Cola that came up with Diet Right first. They beat Pepsi and Coke to the field, but Coke and Pepsi followed with a diet product. And then there's been Coke Zero, and there's the new product with Civia. And sure, there are going to be all kinds of products. And some products sell well in certain countries and don't sell in other countries. Georgia coffee is a huge Coca-Cola item in Japan, huge. It doesn't sell that well in some other places. So there will always be local tastes. There'll be changes in taste. Coca-Cola has hundreds of different products, and there will be a different array of products in 5 years from now, 10 years from now. But the one thing I'll promise you is that the kind of Coca-Cola I drink will still be a huge, huge item at that time. But at Heinz, we've got 4 new products coming out very soon, and there's always some evolving, but there's also a huge base for most products. If you take Heinz ketchup, take A1 sauce, with the Kraft does. Take Heinz 57 beefsteak sauce. I was using Heinz 57 beefsteak sauce on hamburger when I was 8 or 10 years old. And I had a steak last night, and I put some on at 84. So there's a lot of continuity in brands, but there's also change. And any intelligent company is going to try and anticipate those changes, and when they find them, try to come up with the best product to satisfy them.
When we bought Coke in 88 and 89, we had this idea about what we thought the business would do over time, but we never reduced it to making a calculation. Maybe we should, but we don't think there's that kind of precision to it. We think it's the right way to think in a general way, and we think if you think that you can do it to pinpoint it, you're kidding yourself, and therefore we think that when we make a decision, there ought to be such a margin of safety that it ought to be so attractive that you don't have to carry it out to 3 decimal places.
Given that you use the same discount rate across companies, for example, in valuing Coke and Geico, how do you account for the difference in the riskiness of their cash flows?
We don't worry about risk in the traditional, the way you're taught actually at Wharton. But it's a good question. Believe me.
But if we could see the future of every business perfectly, it wouldn't make any difference whether the money came from running streetcars or from selling software, because all the cash that came out, which is all we're measuring between now and Judgment Day, would spend the same to us. The industry that it's earned in means nothing except to the extent that it may tell you something about the ability to develop the cash, but it doesn't tell you, it has no meaning on the quality of the cash once it becomes distributable. We look at riskiness essentially as being sort of a go, no-go valve in terms of looking at the future of businesses. In other words, if we think we simply don't know what's going to happen in the future, that doesn't mean it's necessarily risky. It just means we don't know. It means it's risky for us. It may not be risky for someone else who understands the business. In that case, we just give up. We don't try to predict those things. And we don't say, well, we don't know what's going to happen, so therefore we'll discount it at 9% instead of 7%, some number that we don't even know. That is not our way to approach it. We feel that once it passed the threshold test of being something about which we feel quite certain, that the same discount factor tends to apply to everything. And we try to do only things about which we're quite certain when we buy into the businesses. So we think all the capital asset pricing model type reasoning with different rates of risk-adjusted return and all that, we tend to think it is, well, we don't tend to, we think it is nonsense. And but we do think it's also nonsense to get into situations or to try and evaluate situations where we don't have any conviction to speak of as to what the future is going to look like. And we don't think you can compensate for that by having a higher discount rate and saying it's riskier so that I don't really know what's going to happen, I'll have a higher discount rate. That just is not our way of approaching things. Charlie?
Yeah, this great emphasis on volatility in corporate finance, we just regard as nonsense. If we have a statistical probability of putting out $1 million and having it turn into put it this way, as long as the odds are in our favor and we're not risking the whole company on one throw or anything close to it, we don't mind volatility in results. What we want is the favorable odds. We figure the volatility over time will take care of itself at Berkshire.
If we have a business about which we're extremely confident as to the business result, we would prefer that it have high volatility than low volatility. We will make more money out of a business where we know where the end game is going to be if it bounces around a lot. I mean, for example, if people reacted to the monthly earnings of Seas, which might lose money 8 months out of the year and makes a fortune, in November, December. If people reacted to that and therefore made its stock as an independent company very volatile, that would be terrific for us because we would know it was all nonsense, and we would buy in July and sell in January. Well, obviously things don't behave that way, but when we see a business about which we're very certain, but the world thinks that its fortunes are going up and down, and therefore it behaves with great volatility, we love it. That's way better than having a lower beta. So we think that we actually would prefer what other people would call risk. When we bought the Washington Post, I've used that as, it went down 50% in a matter of a few months. Best thing that could have happened. I mean, that doesn't get any better than that. Business was fundamentally very non-volatile in nature. I mean, TV stations and a strong dominant newspaper, that's a non-volatile business, but it was a volatile stock. And that is a great combination from our standpoint.
My question is about Coke. I want to just tell you a story. Sunday, my 17-year-old son had a number of boys over to watch the Super Bowl. I got all the right refreshments, including 2 big bottles of Coke. No other soft drinks, just Coke and water. There was hardly any Coke consumed by these young men. And it gave me pause, and I've read some, stuff about Coke. Sweetened beverages are on decline, and some have suggested, there was a Bloomberg article that suggested Berkshire's investment sort of gives Coke management some cover to not really address the future of the beverage business.
Well, that's an easy one. Coke for many decades, the basic product, full sugar Coke, grew every year. It was like an inevitable march of time. In recent years, full sugar Coke is declining. Now, unfortunately, the Coca-Cola Company has a vast distribution business infrastructure and a lot of other products. So while Coca-Cola as an individual product is declining some, instead of going up the way it always did before, the rest of the businesses are, on average, rising. So I think Coke is still a pretty strong company and will be a respectable investment, but it's not like it used to be when it was like shooting fish in a barrel.
I want to talk about one of the issues that came up repeatedly at the shareholders meeting. Actually, it only came up a couple of times, but I did get a lot of questions related to it in my email box where shareholders were sending things in. And that's Coca-Cola. Joe already alluded to that this morning, and we'll talk a little bit about what has happened. I know we've had a lot to say, but there was some criticism. Some people who didn't understand why, if you thought Coca-Cola's equity plan was excessive, you didn't say something before the vote, and you didn't take your 9.1% of the outstanding shares and vote no.
Yeah, we had no desire, never will have a desire to go to war with Coca-Cola. I mean, it's a wonderful company. It's treated us wonderfully. The management's always been totally candid with us. I think we've got the right leader. I'm sure we've got the right leader in Muhtar Kent. So we had no desire to go to war, but we did think that the program was excessive. And with those two beliefs, we felt the best thing to do was to express our opinions privately to the management, who listened carefully, and to abstain from voting at this meeting. And we think, I know we'll have some very constructive discussions with Coca-Cola between now and when they implement any plan.
Barron's out over the weekend, and there was an article in the back of it from Carl Icahn. I know you're friends with Carl, and I know that you're both on the Giving Pledge together, but this article says why Buffett is wrong on Coke. He's got a different style than you do.
I hope so.
Do you think that, first of all, what do you think about what Carl said? And second of all, do you think that your style will be effective in this situation?
Yeah, I do think our styles will be effective, and I think our style actually would be more effective than the style that might be proposed by Carl. But Carl goes into other types of businesses, and he goes in where, often at least, he goes in where there's a problem. There isn't a problem at Coca-Cola. There was a plan that was proposed that was excessive. It's very easy to make it non-excessive. All you have to do is spread the authorization over more years than the 4 years that they talked about having it in the proxy, and that's easy to do. So whether it actually turns out to be excessive will depend on the actions they take subsequent to this, because they have not locked it in stone that they're going to use the stock over 4 years. But I would say that generally, or frequently at least, Carl is working with managements with different attitudes, and they probably have a different attitude toward him than Coke has toward me.
Have you spoken with Muhtar Kent to this point? When we talked with you on Thursday, you had not.
I've not talked to him since the meeting.
Since the Coca-Cola meeting?
Since Coca-Cola's meeting, which was on the 23rd.
Okay, so that was about a week and a half ago. One other pointed question that came from a shareholder this weekend, and I got several iterations of this too in my inbox, was your son, Howard Buffett, is on the board.
Right.
He voted in favor of this plan, and there were some people who questioned Howard is expected to be the chairman when you step away from the company to be the protector of the culture there. Does this raise any questions, or should shareholders have questions about his ability to protect the culture when he voted for a plan that you yourself didn't like?
Yeah. I've voted for plans over the years. I've been on boards for 55 years. I've voted for plans that I didn't like. I've actually voted for acquisitions I didn't like. I've opposed a few, too. But there's only so many bullets you can use in the gun. And if you start objecting to this and this and this, pretty soon people don't pay any attention to you, and you want to save your bullets for when they really count. And I have never seen a comp committee come into a boardroom in all my time, and that's happened hundreds of times. I've never seen them come in with a recommendation and heard a no vote. The board delegates to a committee. They say, you go out and work on this. They may say that to the governance committee. You go out and work on getting directors or all kinds of things. And once a board's delegated to a committee and they've spent hours working on something and then they report it and there's 20 other items on the agenda and the chairman calls on the comp committee fellow to give his report, and he gives it in about 30 seconds, it never gets voted against. And it would be regarded as sort of usurping the power of the committee to all of a sudden say, I've got a better idea. I haven't talked to the compensation consultants.
Right.
I haven't looked at the figures, but I still have a better idea. It doesn't happen.
You know, a lot of people have been a little stunned by your comments on corporate governance. I don't think stunned by what you've said, but just that you've said it. There has been this idea that boards are clubby. You've basically come out and said that's the case.
Well, I've written that for 30 years, and I've seen boards operate, and it should be no surprise. It's always interesting to me to read academic discussions of boards, and they have this theory of, that like it'd be in the movies or something. But boards are in part business organizations and in part social organizations, and people walk into those with their behavior formed by dozens of years. Usually, these are people that have achieved some standing, perhaps, too, in the community. So they've learned how to get along with other people, and they don't suddenly change their stripes when they come into a board meeting. So there's a great tendency to behave in a socially acceptable way, and not necessarily in a business maximization way. The motives are good. The behavior is formed by decades earlier, and people like to get along with other people. Most people. Few people. Carl doesn't have that gene quite as strongly as others, and I love Carl. But he may enjoy battle. Some people do that, but generally you don't get invited on boards if you got a person that actually loves a fight.
And your point, I guess, again, people will look at this and be stunned by it. But your point is that this is not too much different than the rest of the world.
Yeah, I think that's very true. And it doesn't mean because you don't get into fights that you can't get things done. And it doesn't mean that there aren't certain issues that I've been involved with a couple situations where a proposal to buy a company has come to the board and it's been shot down. And what happens in that case is that one person finally pipes up, and it's a little bit like the kid saying, the emperor's wearing no clothes and then everybody will come on board. But that first person to speak is belching at the dinner table. And sometimes other people start belching, and sometimes they move further away from you. It depends on the situation. But there are some people that have enough bravery to be followers in a situation like that, but not to initiate it. But you've seen that in other aspects of human behavior.
Mm-hmm. Andrew has a question from back at CNBC headquarters, too. Andrew?
No, I was just saying it's remarkably honest what Warren's saying. The question is whether it should be this way, whether, from the outside, there's a sense that people are more strident in the boardroom, more brave, or more willing to come forward, or that the social issues aren't supposed to impact the way people behave and the way they think, even though, of course, they do. And so I hear you saying this is what happens. My question is, should it happen this way?
Well, no. I mean, obviously, everybody would speak freely and all of that sort of thing, and dialogue would be encouraged, and the chairman would love to hear reasons why his ideas were no good. But it just isn't. It isn't quite that way. And I think it's probably you'll get some of that. But I'll give you a great example. I mean, we bought $700 million worth of Solomon Preferred in 1987. That's the real world.
Right. Hey, Warren, one quick follow-up. In the Wall Street Journal this morning, they were pointing out a comment that you made in 2009 about when you talked about speaking out on the most egregious cases of CEO compensation, and you said, quote, the way to get big shots to change their behavior is to embarrass them. And so I was hoping you could try to explain the distinction between what you were talking about then in 2009 and perhaps this Coca-Cola situation today.
Yeah. Well, I don't really want to embarrass the Coca-Cola company. I mean, I like the people and everything, but
but I think perhaps if you ask some of the people, they would. I don't know whether they use the word embarrassed, but they would have preferred I didn't do it. I'm sure of that. And like I say, I used that word in 2009, so I'm stuck with it. I wasn't looking to embarrass them, but I was certainly looking to have them re-examine what they were doing. And they're in a great position to re-examine it because they haven't used a share of this authorization yet, and they, even though they said in the proxy statement that they expected to use it over 4 years, that could easily be changed. They generally issue, I believe, their options in either January or February, so they have a lot of time to think about what's best. And they are, the one thing I can guarantee you, they are decent, high-grade people, and I think they'll do what's right. But I don't believe that. I don't believe the best way to do that is to go to war with them.
Okay. Warren, if I could ask just quickly, you said in the past there have been deals that you've shot down, and my first thought is to Quaker Oats and Coca-Cola. How did that happen?
Well, it got very public, and basically the management sort of let the world know that Coca-Cola was buying Quaker Oats. And there was a meeting rather hastily called in New York, and the directors went into that room, and I was not the first one to say that giving away 11% or so of the Coca-Cola company to obtain Gatorade primarily, although a bunch of other foods came with it, but Coca-Cola really didn't want the foods, they wanted Gatorade. That we just didn't think, or the fellow that first proposed it, or proposed opposition to it, I should say, said he just didn't think that was mathematically made sense to give away 11% of Coca-Cola to get the single product Gatorade. And I had come into the meeting feeling the same way. I just didn't speak first in that case. And then I spoke, and by the time I got through, the deal did not go through.
And the whole table was belching?
Most of them were belching. I mean, it was sort of a belching contest there for a while. And the company had the whole thing greased to go through. I mean, the press people were there. It was in the evening, as I remember, and everybody was on deadline, and let's get this done. There's usually that sort of momentum attached to any deal, and you can't oppose 5 in a row. I mean, it just, you become totally ineffective at that point. But that was a big deal, and a number of the directors had reservations about it, and that became apparent as this first director spoke up, but the other ones probably wouldn't have spoken up.
Including yourself?
I'm not sure. Well, we won't know that because they didn't. I think I probably would have. I mean, that was not a deal that made sense to me.
According to a peer-reviewed study by Tufts University, soda and sugary drinks may lead to 184,000 deaths among adults every year. The study found that sugar-sweetened beverages contributed to 133,000 deaths from diabetes, 45,000 deaths from cardiovascular disease, 6,450 deaths from cancer.
I think the people who ask questions like that one always make one ghastly error that's really inexcusable. They measure the detriment without considering the advantage. Well, that's really stupid. That's like saying we should give up air travel through airlines because 100 people die a year in air crashes or something. That would be crazy. The benefit is worth the risk. And if every person has to have about 8 or 10 glasses of water every day to stay alive, and it's pretty cheap and sensible and improves life to add a little extra flavor to your water and a little stimulation and a little calories if you want to eat that way, there are huge benefits to humanity in that, and it's worth having some disadvantage. We ought to have almost a law in the editorial, I'm sounding like Donald Trump, where these people shouldn't be allowed to cite the defects without citing the offsetting advantage. It's immature and stupid.
I admire Roberto Goizueta and Don Keogh, who retired recently, but they were one of the great two-manager combinations in the history of business at Coke. They took the market value from $5 billion to now $60 billion in a matter of 11 or 12 years.
They were a perfect partnership. I've seen probably 3 or 4 partnerships in business that really just stand out from all the rest. And certainly when Roberto and Don combined their strengths, it really was a case of 2 + 2 equaling a lot more than 4. They were complementary to each other in an extraordinary way, and neither would have achieved the success they did without the other one. But Don was indispensable to Roberto. I watched that for many years.
Discovering your investment in Coca-Cola, that somehow Roberto may have asked Don what's going on, and he said to Roberto, let me make a phone call. I know a guy. And he called you up to say?
Yeah, well, we bought about 6% of the company, and I don't like anybody to know when we're buying because it causes the price to go up. So I didn't tell anybody. And all of a sudden the phone rang one time, and I pick up the phone, and I can remember his exact words. He said, Warren, he said, you wouldn't be buying a share or 2 of Coca-Cola stock, would you? And the cat was out of the bag.
Are likely to be helped by a great increase in prosperity in what is now the third world. And I'm not so sure that's true of a lot of other businesses.
We like the international businesses we have, and as I say, that our 3 top holdings all have a major international aspect to them, and really in aggregate a dominant international aspect to them. And there's no question in my mind that a Coke will grow faster outside of the United States than in the United States, and the same is true of Gillette, and really the same is true of American Express. So that's built into our evaluation of those businesses. But I felt that way before 1989 too. I mean, it's very hard to evaluate how the ball is going to bounce generally, but around the world. But it is a plus to have products such as Gillette has or Coke have that have demonstrated the fact that they travel extraordinarily well around the world. That people crave those products, and that they're going to. No one's going to find a way to do it better than those 2 companies in their respective fields. So, and they sell an inexpensive products. So, all of that's going for us. But in terms of how stocks generally sell or the profitability of American business generally is in the future, it doesn't help me much.
You really have to come to your own conclusion. The Coca-Cola Company writes, their annual reports are extremely good. I mean, they're very informative. My guess is that, at least if you read a few of the reports, you absolutely know as much about the Coca-Cola Company as I would. But in the end, you have to make your own decisions about growth, potential profitability, potential, and all that. But the one thing I can assure you is that if you spend a relatively small amount of time on it, the facts that you will have available to you for making a decision on that question will be just as good, essentially, as the facts you'd get if you'd worked at the Coca-Cola Company for 20 years or if you were a food and beverage analyst in Wall Street or anything of the sort. That's the kind of businesses we like to look at, are things that we think we can understand that way. And they're also businesses that usually I think you could understand that way. But we don't like you to give you our answers. I mean, that would not be a good idea. It's a very good question. The question about Coke's advertising in Japan, as you know, Coke has a terrific presence in Japan. Japan's an interesting market because the percentage of soft drinks sold through vending machines is just far, far, far higher than any place in the world. And the United States is a very distant second. And then the rest of the world, there's very little done in the way of vending machines. I don't know the specifics of the advertising in Japan, but of course Doug Daft, who now is the CEO of Coke, comes with a huge background in Asia. And I mean, that was his territory for much of his career. And Doug, we have a new very major advertising campaign coming up, and you probably read that Coke is going to spend $300 million plus additional on marketing beyond the normal spend, which is huge. And I can't tell you the specific markets in which that will be, but I would be surprised if Japan isn't a big part of it, because Japan is an enormous market for Coca-Cola. Charlie?
I have nothing to add. Let's say that this caught on and that it was a
nationwide ban on any Coca-Cola sold in a container that had sugar, any Coca-Cola sold over 16 ounces. Does that make sense to you to do that for the obesity problem? You're a big Coke shareholder. And then I think about, Dairy Queen, and, ice cream's not good for you either. And I figure there must be a way that's adding to obesity. Do you see this as something that makes sense to you?
First of all, I got to say Dairy Queen sales were up 5.8% in September, same store, so that we did quite a bit better than McDonald's.
But you see where I'm going with this.
But and ice cream, I thrive on ice cream. I eat it for breakfast sometimes, and I may eat too, so you'll have to judge how
somebody
I'm doing on this.
somebody might not like you doing that at your age, Warren, adding to cholesterol, and you might get taxed on it because we don't really think it's a good idea for you to have ice cream for breakfast. Is that okay?
Yeah, well, let's look at the 16 ounces of Coke. 16 ounces of Coke has 200 calories in it. And I would say that there are an awful lot of servings of an awful lot of things that have 200 calories or more. And the idea that you should say that you could drink 200 calories of something but not 210 or 220 seems to be kind of silly. In the end, I've elected the foods to eat over the years that I like to eat, and I think it's kept me quite healthy. And I think if I'd been on broccoli and spinach, I'd have been going a long time ago.
To me, why don't you tell me it's preposterous and Bloomberg has got a screw loose? Why don't you say that?
Well, because you said it for me.
I've had people in from Mount Sinai, doctors that tell me, hey, cigarettes. You don't want to. It's like cigarettes. You don't want to tax cigarettes. We can't tax. And I go, well, red meat 20 years ago was supposedly the cause of all heart disease, and oops, that may not have been the end all be all. So when do they decide?
I eat lots of red meat.
No, it's not.
I eat lots of red meat, Joe. I drink about 60 ounces, about 5 12-ounce cans of cherry Coke a day. And that's 750 calories. But I like to get, I'm going to burn up 2,700 calories or so a day, and 750 of them are going to be cherry Coke. And my doctor told me during this thing, he says, drink more liquids. And I said, how about cherry Coke? He says, it's fine.
It's insanity. It's insanity, and someone needs to tell this guy that. Although he's still going to be every Democrat or every Republican's favorite Democrat. I don't know, Andrew. God, if he ran for president, you'd be out there. You'd have 40 signs in your yard. Bloomberg for president. If you had a yard.
I think. I got to say, Mayor Bloomberg has done a lot of terrific things. I've seen him do it in charity, all kinds of things.
Well, this ruins it.
But I also had dinner with him in Sun Valley right after this came out. And when they brought out the dessert, there was more than 200 calories in this dessert. And I was unable to determine why those 250 or 300 calories of dessert he was eating was different than my 20 ounces of Coke.
Do what I say, not what I do.
Did you ask him about that?
I actually had a great big bottle of Coke brought out. It was the biggest bottle I could find at Sun Valley.
You really did?
Yeah, absolutely.
And did he drink from it?
I drank from it. I wasn't going to let him have any.
This is one of your big four investments, Coca-Cola. And Chris Kreller writes in, why do you not increase the Coke stake? The name is near eternity, and this company seems to be a never-ending cash cow. You own 9% of the shares outstanding?
Yeah, we own 400 million shares, and we haven't bought or sold any stock for 20 years. There are other things that I think are cheaper. We bought Wells Fargo this year. I think Wells Fargo is cheaper than Coke. I may be wrong. I think they're both wonderful companies. There are all kinds of colas that came after Coke. I mean, you go back to 1886 and come up with something at Jacob's Pharmacy that's incredibly successful. Fairly soon you're going to get lots of imitators, but Coke really is the real thing. And you offer me RC Cola and say I'll give it to you at half the price of Coca-Cola in terms of drinking it. I mean, this is a product that's 6.5 ounces, sold for a nickel in 1900. And now if you buy it on the weekend and buy it in large quantities and everything, you're not paying that much more. This newspaper was 3 cents in 1942. The amount of enjoyment per real, in terms of the real of what you pay for this, has gone dramatically down in inflation-adjusted money. So it is a bargain product. You have to look at See's Candy. If you live in California and you were a teenage boy and you went to your girlfriend's house and you gave the box of candy to her or mother or father and she kissed you, you lose price sensitivity at that point. That's yeah. So we really want products where people feel like kissing you, rather than slapping you. It's an interesting thing. I mean, in effect, we're betting on the ecosystem of Apple products, but led by the iPhone. And I see characteristics in that make me think that it's extraordinary. But I may be wrong. And so far, I would say we've been right on American Express and Coca-Cola. American Express had this huge salad oil scandal in 1960, happened in 63, November, right around the time Kennedy was shot. And there was really worry about whether the company would survive, but nobody quit using the card. Nobody quit using the traveler's checks. And they charged a premium price for their traveler's checks. So there are things you can see around consumer products that sometimes can give you a pretty good insight into the future, and then sometimes we make mistakes. Charlie?
I got nothing to add, except that if we'd been offered a chance to go into Coca-Cola right after it was invented, we probably would have said no.
We'd have turned to them. Yeah.
It would have looked kind of silly to us.
Well, unless we drank it. Now, Charlie, listen. No, he's right. I mean, we don't foresee things that we haven't got a lot of evidence in on. I mean,
no.
We want to see a lot of, if we're talking about a consumer product, we want to see how a consumer product behaves under a lot of different circumstances. And then we want to use something, actually, there was a book by Phil Fisher written around 1960 called Common Stocks and Uncommon Profits. It's one of the great books on investing. And it talks about the scuttlebutt method of investing, which was quite a ways from what Ben Graham taught me in terms of figures. But it's a very, very good book. And you can learn a lot, just by going out and using some shoe leather. Now they call them channel checks now or something like that. But it's you can get a feel for some products, and then there are others you can't. And then sometimes you're wrong. But it is a good technique. It's an important investing technique, I would say that. And Ted and Todd do a lot of that. And they have some people that help them out on doing it too. Charlie's done it with Costco. I mean, he is. I mean, all the time he is finding new virtues in Costco. And he's right, incidentally. I mean, Costco has an enormous appeal to its constituency. They surprise and delight their customers, and there is nothing like that in business. You have delighted customers, you're a long way home.
They will benefit from increased prosperity, increased standards of living throughout the world. I think we'll see that over any 10 or 20-year period. I think people's preference for Coke will do nothing but grow, Coca-Cola products. So what I am concerned about is share of market, and then what I call share of mind. In other words, what do people think about Coca-Cola now compared to 10 years ago or 20 years ago? What are they going to think about it 10 years from now? Coca-Cola has a marvelous share of mind around the world. Everybody in the world almost has something in their mind about Coca-Cola products, and overwhelmingly it's favorable. You can't, try to think of 3 other companies like it. I can't do it in terms of that ubiquity of good feeling, essentially, about the product. We measure it by unit cases sold and by shares outstanding, and we want a lot more unit cases sold, and we like the idea of fewer shares outstanding over time. I'll be giving you that same answer 10 or 15 or 20 years from now, and I think there'll be a lot more unit cases sold then. It is true that the case growth slowed starting in the second half of last year and continuing through the first quarter of this year. But that's happened from time to time in the past. In my view, that is not, it's not an important item. It may be an important item in what the stock does.
in a 6-month period or a 1-year period. But we'll be around 10 years from now, and Coca-Cola will be around 10 years from now. And right now we own 8.1 or 2% of Coca-Cola, and we'll probably own a larger percentage 10 years from now because they'll have probably repurchased some stock. The PE ratio of Coke, like virtually every other leading company in the world, strikes us as, they all strike us as being quite full. That doesn't mean they're going to go down, but it does mean that our enthusiasm for buying more of these wonderful companies is less than it was when the PE ratios were substantially less. Ideally, those are the kind of companies we want to buy more of over time. We understand their businesses, that there's a reasonable chance, at least, that sometime in the next 10 years we buy more shares of either Coke or Gillette or American Express or some of those other wonderful companies we own. We do not like the PE ratios generally, but again, I stress that does not mean they're going down. It just means that we got spoiled in terms of how much we got for our money in the past, and we hope that we get spoiled again. Charlie?
Yeah, if what matters to you is what you think Coke is going to look like 10 years out or even further out, you don't really pay much attention to short-term economic developments in this country or that, or currency rates or any other such thing. They don't really help you in making the 10 or 15-year projection, and that's the one we're making. So we have tuned out all this noise, as it's called in what communications networks. Tune out the noise, and if you look at the big picture, we think Coke is fine.
It's hard to think of a better business in the world among big businesses. There's obviously companies that are starting from much smaller bases that could grow faster, but it's hard to think of a much more solid business.
I've been to 3 annual meetings and have heard great things about Coke every year, but as far as I'm aware, you have not bought any additional shares of Coke over the last 3 years, even though the stock has done just fine. If an investor has a relatively short time frame, say 3 to 5 years, how much weight do you think one should give to quality versus price?
Well, if your time frame is 3 to 5 years, I wouldn't advise it being that way, because I think if you think you're going to get out then, it gets more leaning toward the bigger fool theory. The best way to look at any investment is how will I feel if I own it forever, and put all my family's net worth in it. But we basically believe in buying, if you talk about quality, meaning the certainty that the business will perform as you expect it to perform over a period of time, so the range of possible performance is fairly narrow. That's the kind of business we like to buy, and all I can say is that we like to pay a comfortable price, and that depends to some extent on what interest rates are. We haven't found comfortable prices for the kind of businesses we like in the last year. We don't find them uncomfortable in the sense that we want to sell them, but they're not prices at which we added to Coke one time about, 5 years ago or thereabouts, and it's conceivable we would add again. It's a lot more conceivable we would add than subtract. But that's the way we feel about most of the businesses. We did make a decision last year that we thought bonds were relatively attractive, and we trimmed certain holdings and eliminated certain small holdings in order to make a bigger commitment in bonds. Charlie?
Yeah, you talk about quality versus price. The investment game always involves considering both quality and price, and the trick is to get more quality than you're paying for in the price. It's just that simple.
But not easy.
No, but not easy.
I've been on the board of Coke now for 10 years, and we've had project after project come up, and there's always an ROI, but it doesn't really make much difference to me, because in the end, almost any decision you make that solidifies and extends the dominance of Coke around the world in an industry that's growing by a significant percentage and which has great inherent underlying profitability, the decisions are going to be right. And you've got people there that will execute them well.
You're saying you get blooper after blooper.
Yeah. And then Charlie and I sat on U.S. Air and the decisions would come along, and it would be a question of, do you buy the Eastern Shuttle or whatever it may be, and you're running out of money, and yet to play the game and to keep the traffic flows such as with connecting passengers and everything, you just have to continually make these decisions, whether you spend $100 million more on some airport, and they're agony, because, again, you don't have any real choice, but you also don't have any real conviction that it's going to translate, those choices are going to, or lack of choices, are going to translate themselves into real money later on. So one game is just forcing you to push more money into the table with no idea of what kind of a hand you hold, and the other one, you get a chance to push more money in, knowing that you've got a winning hand all the way. Charlie? Why'd we buy US Air? Could have bought more Coke. Repurchases shares, and our interest goes up. We owned 6.3% of Coca-Cola in 1988 when we bought in. We actually increased that a little bit a few years later. But if they had not repurchased shares, we probably would own about 6.7% or 6.8% of Coke now. As it is, we own a little over 8% through repurchases. There are going to be about 1 billion 8-ounce servings of Coke sold around the world, or Coca-Cola products sold around the world today. 8% of that is 80 million, and 6.8% is 68 million. So there are 12 million extra servings for the account of Berkshire Hathaway being sold around the world, and they're making a little over a penny a serving. So, that gets me kind of excited. And I think all I can tell you is I approve of Coke repurchasing shares. I'd a lot rather have them repurchasing shares at 15 times earnings, but when I look at other ways to use capital, I still think it's a very good use of capital. And maybe the day will come when they can buy it at 20 times earnings, and if they can, I hope they go out and borrow a lot of money to buy a ton of it at those prices. And I think we will be better off 20 years from now if Coke follows a consistent repurchase approach. I do not think that is true for many companies. I mean, I think that repurchases have become in vogue and done for a lot of silly reasons. And so I don't think everybody's repurchase of shares is well reasoned at all. We see companies that issue options by the ton, and then they repurchase shares much higher. I started reading about investments when I was 6, and I think the first thing that I read was, buy low, sell high. But these companies, through their options, they sell low and then they buy high, and they've got a different formula than I was taught. So there are a number that we don't approve of. But when we own stock in a wonderful business, we like the idea of repurchases, even at prices that may give you nosebleeds. It generally turns out to be a pretty good policy. Charlie?
Well, I think the answer is that in any company, the stock could get to a price so high it would be foolish for the corporation to repurchase its shares.
Sure.
And you can even get into gross abuse. Before the crash, the Insul utilities were madly buying their own shares as a way of promoting the stock higher. It was like a giant Ponzi scheme at the end. So there's all kinds of excess that's possible, but the really great companies that buy at high price earnings, that can be wise.
Our interest in GEICO went from 33% to 50% without us laying out a dime, because GEICO was repurchasing its shares. And we benefited substantially, but we benefited a lot more, obviously, when prices were lower. I mean, our interest in the Washington Post company has gone from 9.5% to 17.5% over the years without us buying a single share. But the Post or Coke or any number of companies don't get the bargain in repurchasing now that they used to. We still think it's probably the best use of money in many cases.
Like a Coke, for example, where 25 years ago they would not have repurchased stock, and so they'd have piled up more equity in the business. And Coke's return on equity, if it had been following the policies of 1970 or 75, would be far less than it is now. Coke really doesn't need equity. And so it can earn extraordinary returns and very large dollar sums. To the extent that impacts the figures, that has some impact on them. To the extent that General Motors sets up many billions of a reserve for post-retirement health benefits, that tends to make the return on GM look a lot better than it did in the past when it wasn't even recognizing those costs and therefore had an equity that really was much larger than the true equity. So there have been some things happen like that, but all in all, I don't think under any system of accounting the 20% returns for American industry are in the cards. Charlie?
Well, I agree, and I think that this business of having way more consolidation and the successful companies like Wells Fargo buying in stock, I think that's had a huge effect too. I don't think it's actually gotten that much. Obviously, we had a long period of real growth and so on, and I think that on average, business has earned higher returns on equity. But I think a whole lot of things have combined to goose the results, and I don't see how it could go much farther.
In the annual report a few years back, you described Coca-Cola and Gillette as the two invincibles. With Pepsi as a strong competitor today, do you still continue to view Coca-Cola as the invincible?
I think the term I used was inevitables, actually, but it's very close to the same thing. And I think when I made that statement, I said Coca-Cola in soft drinks or Gillette in blades and razors. I mean, I did not extend them to the entire corporate portfolio, particularly in the case of Gillette, but to the blade and razor business. Gillette now has 71% by value of the blade and razor business in the world. Just think of that. I mean, 71%. Here's a product that everybody knows what it does. They know how to make, they know where it's sold. They know that it's a high margin business. I mean, it isn't like the world, or the capitalist world's unaware of the money that could be made if they could knock off Gillette, but they can't knock off Gillette, and it's 71%. And that's a little higher percentage than when I wrote about it. Actually, Coca-Cola's worldwide market share is a little higher now than it was when I wrote that 5 years ago. And I would say that 5 or 10 years from now, I would be amazed if Gillette or Coca-Cola have lost market share in their respective fields. Coca-Cola sells half, roughly, of the soft drinks in the world, and soft drink consumption per capita goes up basically every year, and the per capitas go up. I mean, the capitas go up every year also. So you get these gains. Maybe they're 3% or 5% in units or 4%. It was 5% in the first quarter, but it was poorer than that. I think it was 3% last year. But when you have half the world, and the world's population is growing at a little under 2%, and you're getting 3 or 4% from something that's as pervasive as soft drinks, you're doing all right. The Coca-Cola business has done fine. People went crazy in terms of valuing some of these businesses a few years back, and I think we had some cautionary language in there generally about the valuations at which the businesses sold. But the businesses, 71% in blades and razors. There's some countries where it's 90. In the U.S., it's also about 70%. Those are huge market shares of something people use every day. In this country, it's a little over 8 ounces per day, actually more like 9.5 ounces per day for every man, woman, and child in the United States out of the 64 ounces they drink. Well, you're not going to have galloping percentage increases from that arena, but the company's made basically good progress. People got carried away from the stock, and I would argue that they may have gotten encouraged a little bit too much by not only Wall Street but even by company pronouncements in terms of possibly attainable gains. There aren't large companies. There may be one someplace somehow very large now that will grow at 15 or 18% a year, but it just isn't in the cards in the world, and we don't want anybody to think Berkshire could do that either, because we can't do it from
a very large base. The world doesn't allow that. But it does allow making reasonable progress. And certainly Coke and Gillette, in those areas where I said they were inevitable, have done very well.
I wondered if you could comment on the views of those people who have stated that because of so-called conflicts of interest, you should leave the board of Coca-Cola, and whether you had any intention of doing so.
I would say that whoever suggested that should do 500 sit-ups. Actually, Charlie and I, certainly I have, well, I'll let Charlie speak for himself. We like the idea, and we've encouraged the idea of shareholders behaving like owners. I mean, shareholders have too often behaved like sheep in this country, and they got shorn in many cases. And big institutional shareholders have sat on the sidelines while some things that might possibly have been corrected had they gotten active took place. And so we actually applaud the idea of shareholders behaving like owners. The question is whether they can behave like intelligent owners. And I think that in the last year or two, as they've sort of woken up, they've searched for checklists of one sort or another to determine whether directors are appropriate in a given company or not. And frankly, checklists are no substitute for thinking. The real job of the directors is to come up with the right CEO for a company and prevent him or her from overreaching. If they do that job well, the rest takes care of itself.
Yeah, I think that the corporate America needs a fair amount of reform, but the cause of reform is hurt, not helped, when an activist makes an idiotic suggestion, like the one that having Warren Buffett on the board of the Coca-Cola Company is contrary to the interests of the Coca-Cola Company. Nutty activities do not help the cause for which the person speaks.
The bottling transactions are incidental to a long-term strategy which, in my view, has been enormously successful to date and which has more successes ahead of it. But in the process of rearranging and consolidating the bottling system and expanding to relatively undeveloped markets, there have been and there will be a lot of bottling transactions, and some produce large gains, some produce small gains. I ignore those in my evaluation of Coke. The two important elements in Coke are unit case sales and shares outstanding. And if the shares outstanding go down and the unit case sales advance at a good clip, you are going to make money over time in Coca-Cola. There have been transactions where people have purchased rights to various drinks. Coca-Cola's purchased some of those around the world. And when you see what is paid for 1 million or 100 million unit cases of business, and then you think to yourself that maybe Coke will add 1.5 billion cases a year, that's a real gain in value. It's a dramatic gain in value, and that is what counts in terms of the Coca-Cola Company. If you think the Coca-Cola Company is going to sell some multiples of its present volume 15 or 20 years from now, and you think there'll be a lot fewer shares outstanding, you've gone about as far as you need to go. But I would pay no attention to asset gains. I would just take those out of the picture. Now, as to quality of earnings, Charlie and I feel that in several respects, but in one important respect, that the quality of earnings has gone down, not because the policy has changed, but because it's just become more significant, and that's in the case of stock options. There are certain companies that we've evaluated for possible purchase where in our calculation of earnings, the earnings are maybe 10% less per year, per share, than reported. And that isn't necessarily the end of the world, but it is a difference in valuation that is significant and is not reported under standard accounting. So we think the quality of earnings as reported by a company with significant stock option grants every year, we think is dramatically poorer than one where that doesn't exist. And there are a lot of companies that fall in that category. Coca-Cola's earnings are very easy to figure it out. Just figure out what they're earning per case from operations, and you'll see over the years the earnings per case go up, and the cases go up, and the shares go down. And it doesn't get much more complicated than that. Charlie?
You've said it wonderfully. I just wish we had more like that.
Yeah.
After Don left Omaha, we kept in touch over the years. I'd meet him at the Alfalfa Club, or once we even met at the White House. Then he read an article in 1984 in which I praised Pepsi, quote, preferably with a touch of cherry syrup in it, quote. The next day, Don sent me their new product, Cherry Coke, and invited me to taste test the nectar of the gods. After I drank it, I told him, forget about your testing. I don't know much about that stuff, but I do know this is a winner. I switched brands straight away and immediately declared Cherry Coke the official soft drink of Berkshire Hathaway. A few years later, I started buying Coke stock, but I didn't tell Don because I felt he might have to tell the company lawyer, and who knows where that would have led. I didn't want to put him in an awkward position. Anyway, he called and said, you wouldn't happen to be buying a share or two of Coke stock now, would you? I told him, it so happens that I am. At the time, we picked up 7.7% of the company. It was a straightforward decision, especially knowing that he was president. I saw Coke in 1988 as a company that understood what it was doing and was doing the right thing, and was obviously enormously valuable as the result.